Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at a model portfolio from Fidelity, specifically Fidelity's US equity defensive factor ETF. So as per its name, this is a defensive portfolio. And if you look at the underlying ETFs, we can see this portfolio is comprised exclusively of Fidelity ETFs, a bit of cash, and the constituent with the largest weight is the Fidelity low volatility factor ETF with a 45% weight. Now, given that it's a defensive portfolio, this large allocation to low volatility is not surprising. What perhaps is surprising that the allocation to the Fidelity quality factor ETF is only 10%. Now, let's kick off with a benchmarking exercise, and we're going to use the S&P 500 in this case. And what we do see is that if we roll back this portfolio, that basically since 2019, this portfolio has underperformed. We can see the excess return is consistently negative. We can also see that the Sharpe ratio of this portfolio over the last 6 years, right, was 0.49 versus 0.54 for the S&P 500. Now, having said that, given that this is a defensive portfolio, the aim is not to outperform the market, right? It's to provide perhaps better risk-adjusted returns, which it didn't do, or perhaps lower drawdowns in periods of market stress. So let's explore that. And for this, we're going to go to the risk tab, where we can look at the kind of like drawdowns for the last 6 years, which the largest drawdown effectively is the drawdown during the COVID crisis. And so here we have the maximum drawdowns, right? And what this actually shows us that this portfolio during the COVID-19 crisis in 2020 didn't do better than the S&P 500. And we can explain that by the large allocation to the low volatility factor ETF. And that's simply because these kind of low volatility, low risk stocks did not do very well during COVID. A typical example of low vol stocks are REITs. But during COVID-19, people stopped going to the offices, stopped going to shopping centers. Having said that, in later periods, effectively, right, this model portfolio Fidelity did have lower drawdowns, right, than S&P 500, right? So it's worth investigating how it has achieved that. And one way to look at that is do a simple factor exposure analysis. And we can do that for asset classes as well as for equity factors. And what we see here is that the betas to major asset classes, effectively the only beta is relevant is the one to the S&P 500, is on average 0.8. And that of course also explains, right, why on average, right, the drawdowns of this portfolio are lower than that of the market because your beta is lower, right, at 0.8. Now, having said that, what is worth mentioning that if you look at this portfolio in terms of what are the major risk sources, effectively we can see that it's still the stock market, right? So despite this being a defensively named portfolio, this does not provide diversification. It's all equity in there, right? And despite this allocation to this factor ETFs, right, these don't really matter from a risk source perspective. Now, the common question that we ask ourselves is if you have a portfolio like this one that has 7 underlying factor ETFs, is there a factor offsetting going on? And factor offsetting simply means that you have these kind of factor-based ETFs where the underlying factors are negatively correlated. And that's naturally not great. And we can evaluate that. So we can look at the holdings analysis, where you do see the factor betas for each of those underlying ETFs. And indeed, so here, for example, are the beta to the value factor. And as we can see, negative, positive, negative, positive, positive, positive. Effectively means factor offsetting is going on. And you can see the same thing for the size factor, momentum factor, quality factor, and low vol factor, right? Where these instruments effectively just offset the exposures, right? So that simply means, right, that this portfolio is not as well constructed as it could be, right? You could have a sharper focus, right, in terms of selecting only instruments, right, with the fact that betas don't offset each other. But this is something that we see quite often in portfolios, right, where too many flavors are combined, and as when you cook, too many flavors often spoil the dish. Now, this is a little bit in terms of looking at the portfolio from benchmark perspective, right? So we can also ask ourselves the question, can this portfolio be simplified? And short answer, yes. So as we know, this portfolio has around 7 constituents, right? But we can literally simplify this portfolio into just 3 ETFs, which is the Russell 3000 ETF, a mid-vol ETF, and the S&P 500 value. And as you can see from a cost perspective, it's almost the same, 18 basis points versus 19 basis points. But you actually would have gotten a portfolio, right, that would have had slightly higher return. And so this kind of concludes our short review of Fidelity's US Equity Defensive Factor ETF, right, which is a model portfolio with a defensive positioning. From a return perspective, this has underperformed the S&P 500 over the last 6 years, but that's fine for defensive product. What is less attractive, that it hasn't done better from a sharp perspective, that the drawdowns in some cases were lower than of the market, in some cases were the same, and then we can explain the lower drawdowns simply with exposure to the low vol factor ETFs. And also what is not particularly good about this product is that you have too many smart beta ETFs that have conflicting factor exposures. So that means factor netting or factor offsetting is going on, and in like a sharper focus, i.e. having less instruments, would have made this a better product. Hope that helps. Have a nice day.